All right, welcome to the roundtable. Today is the 28th of September, 2023. One more day for trading for the end of the quarter. But Wayne has a really interesting indicator. We've had it on the website for a while now, just for people to try out. I think a couple thousand page views on that page. But it's pretty interesting at the money butterfly edge indicator. So Wayne's been working with me for, geez, I guess about 2 years now, Wayne.
Yeah, it's
And
been a while. Shoot, it might even be longer than that. I think it's been three, maybe. It's been a long.
It's been a while, a couple of years for sure. But Wayne's really great, really analytical, really great with all the fundamentals like the economy and interest rates and all that kind of stuff. So um, Wayne's put together this interesting indicator for butterflies based on a lot of his research, and I think you're gonna like it. But Wayne, I'll stop talking and let you take over. Do you have a disclosure you want to go through, or?
Yeah, it's on my next page. It includes you and me on that one.
Okay, perfect. All right. Well, I'm going to mute myself just so there's no background noise, but I'll be here for the whole thing. So
Yeah,
welcome.
absolutely. And just a little bit of housekeeping before we get going. Feel free to interrupt along the way. I am going to get slightly into the weeds with some of the stuff we're going to talk about, but hopefully I don't get too deep. I try not to get like super math heavy intensive with these types of things, just because that typically blows some people's minds and frankly mine as well.
Sure.
So what so anyways, Tom, interrupt me along the way
Will do.
if there's a question. All right, big guy. So today we're going to go over the Abe indicator, and I call it the Abe indicator. It actually stands for at the money butterfly edge indicator, but how it works and basically why I use it, how I use it, and then we'll go through some examples as well with O&E in just a little bit. So before we can go through anything, of course, we've got to hit up the legalese, right? So Aramir Environmental Trading Edge and its members are not broker-dealers or investment advisors. All webinars and seminars and everything like that are for educational purposes only. Past performance is not indicative of future results. All trades are hypothetical and for educational purposes only. Let's see, yeah, for personal use only and for non-commercial. All right, that should have cranked through it for just a little bit of introduction, even though Tom actually was um, awesome about introducing me. I just kind of want to give you guys a little bit of background about me, just in case this is your first time running into me. My name is Wayne Klump. I'm a strategy developer and a professional options trader. I used to work at a hedge fund and work with other institutions building strategies and really blending esoteric strategies. That's my specialty, and then trading derivatives on broad-based indices. It's a bunch of fancy words there, but basically, in general, what I do is I take different strategies or different income streams and blend them together and reduce risk and optimize the return profile of them. And then also I trade on SPX and Russell and NDX and things like that. So just to kind of simplify things down, I am an expert here over at Aramir, as we call them. So I have a couple strategies over here. They're my macro based, just ETF based strategies that are very, kind of laissez faire, touch them once a week. You don't really have to manage them too much. And they're nice and stable through different business cycles. And then, of course, I am the managing partner at Environmental Trading Edge, LLC. And that's where I have some of my own personal strategies that I put up there. So, uh, beyond that, let's get right into there's a lot of strategies out there, and a lot of them kind of are, without better word, derivatives of, some sort of like butterfly or condor that sometimes sit around the money. So like this one down here, let me get my pen together here. So this one down here is very centered at the money, right? And this is you can see this with O&E. And I mean, if you're not familiar with risk graphs, I'm going to be basically throwing a bunch of these up there at some point in time. But basically, this is an expiration line, this big line back here, and this kind of tells you where you're anytime that you have a structure that kind of bends over and you've got negative gamma, it basically is a short position. So any type of structure that has these kind of shorts or these bends like this, and they kind of make mountains and things like that, anytime you get near the money with those types of things, or you're in these kind of condor structures, they have very specific signatures for how they're priced and how they decay. in the markets. And so, one thing that I'll ask everyone just to kind of think about, if you want to throw it in the chat, you're more than welcome to. It's always good to hear it. Typically, when I ask this question in some sort of, like a questionnaire, I normally get a ton of people that say that they've ran into this. But the question is, how many times have you put on a structure, especially something that's dated out at, maybe 21 or 30 or 40 or maybe 50 or 70 DTE, and you've been sitting in it for what feels like forever, and the thing just has not decayed, right? You're just kind of like, what is going on here? Why is this thing not, ballooning? And I've made a couple, videos about, how theta is kind of a garbage Greek, but in essence, what you'll see, especially structures like this one, or that are like, bearish butterfly type structures, they are really, really dependent on a couple of these variables we're going to talk about today. And it's really interesting why certain strategies don't decay very well, or have reduced edge, or purchased at a bad time. And the AVE indicator is meant to fix this, or at least alleviate some of that pressure, to where when it's an optimal time, and you're likely to get the actual decay or more decay than what we are anticipating. And then also not even just the decay, but then it's actually more robust in market movements as well. And it's because of how these options are priced. So then I use this in my own trading, right? So this is like an adapt advanced structure, where you just got a conglomeration of all sorts of things that are getting thrown on, and you're moving pieces around and everything like that. But I use this every day. This is the number one tool that I use in this system, along with the other metrics that are in there. But I mean, it's like flying blind. I literally, it's like not having an instrument. It's kind of like if you were to, Tom, I know you're a pilot, but if you're, out in the middle of the ocean, it's pitch black at night, and you don't have like an altimeter or something like that, and you have no idea how high or low you are. And it's just without flying blind, right?
Hey, it's Spatial D.
Yeah, it's scary to not know. And so to know if a structure has an edge in the market based on its pricing and things like that is just paramount, right? Like I said, it's like an altimeter, or it's like your horizon bulb, or whatever it's called on an airplane. I'm trying
Artificial
to throw some.
Horizon.
Sure, thank you. Perfect.
There you go.
Yeah. So today we're going to kind of crush through some things for like elements that are built into this Abe. It's not everything, because I do have proprietary options models and machine learning algorithms that are built into this, but I am going to just at least go over the overview of what we can kind of look at to tell that there are different environments, and a structure isn't necessarily advantageous at all times in the markets. And so making sure that you're grabbing things at the right time is really important. So first and foremost, we're going to go through uh, the spreads volatility, and that's going to be different than volatility. And then we're going to go through what's called contango. And if you've never heard of any of these terms, I'll try to just kind of explain it along the way and make things a little bit easier. So first, we're going to go through a quick intro into just volatility, just in general, with like a single option and kind of what it looks like on a volatility surface. And then we'll go into the volatility of spreads, and I'll show you guys some cool graphs on that. And then I'll go into contango decay, and that's going to really probably maybe blow some minds. I know it blew my mind when I first discovered this, probably, I don't know, gosh, it's been 10 years now. It's anyways. So moving forward, then we'll go into the Abe indicator and kind of what it looks like, how to use it, its current value interpretation, and some historical examples that I can jump into O&E and show you. And, depending on what our time is, how many of those I show you. And then, of course, you guys, if I've got enough time, you guys can throw some random dates at me for maybe some sticking points in your own trading that have maybe caused problems, or maybe have been really profitable times, and we can go look at what they are in the Abe indicator if you trade a structure very similar to these. And then we'll go into kind of some of the trade systems that I think what I've seen data wise that do a large correlation to these or to this indicator. All right, so first things first, we're going to go into some volatility. So, well, what is volatility? Like I said, we're going to kind of go through, we're going to build this up, right? So, we're going to start at the beginning. So, if this is a little bit of overlap for you, just kind of hang with me. We'll get into the little bit of a deeper weeds. And if this is the first time kind of hearing some of these terminologies, just try to stay a little bit high level and try not to get too much into the weeds as well. So, it should be a blend of both. So, we've got two assets on here. We've got the Dow Jones Industrial, right? And then we've got Tesla. Both over this time period have performed exactly identical, right? And this was all the way from late 2021 all the way to mid June of or mid July of 2023. So both of them, whatever hype you want to hear about them, they basically haven't done anything different. They're the same return, but one is very different than the other. And the one that we are going to focus on is the fact that Tesla back here is gyrating huge swings around its kind of central axis, right? And these huge gyrations create uh, create higher potentiality for getting to various strikes, I should say, right? So basically, there's a higher potential that even though the market might be right here, so we're just going to take this for example, the market might be right here. There is a high potential that the market or the Tesla could actually make it all the way up to this box. So what's happens is the options market will price this much higher, right? So this will be much more expensive than when the Dow is near the same level. And if you're trying to price in a Dow option all the way up here, relatively equivalent at the same level, it's going to be much cheaper, right? Way cheaper. And the reason why is because its potential, because of how much it actually swings around, is significantly lower than Tesla's. So this is just in general the volatility of an asset. So that volatility of an asset impacts what's called, and I know this is crazy because we're going to use the same term, but it impacts the implied volatility of an option. So an implied volatility, let's just kind of remove that term and just turn it into the price of the option, right? Of something that is the potential. So the higher the volatility of the asset, typically the higher the price of an option that's away from where the market is trading. Okay. Now it's, nothing is linear in options. So we're going to, there are definitely exceptions to this, but we're just talking high level before someone, really kind of jumps on and says, hey, you're saying something wrong here. But there are exceptions. I'm aware of that. So anyways, this is the volatility index of the S&P 500 or the VIX, right? And so as the VIX gyrates, right, and has times that it's swinging more rapidly. So a lot of people will remember like COVID, right? So during COVID, the market was crashing. The days were huge. We were getting like 10% days in a single day, right? Massive movements. And so the level of the VIX goes higher. That's the volatility reading, right? How crazy is that underlying? And then of course you've got lower times, which are near down here at 14 or so, or 20, or different levels, right? And all the way down here at sometimes 12 and things like that. So this changes as we go over time. Now, this impacts options pricing and it changes up and down. And a lot of the mistakes that I've ever seen from retail trading, and then of course I made these mistakes too. So when I started to get into this, I always thought that high volatility equals better options pricing, right? And that higher volatility, the options got more expensive. So if I'm a seller of options, it should be good for me and they should decay and I should have an extra edge. And that is definitely 100%. We might as well just take that assumption. We're just going to throw it right out the window because it's total garbage. And I can prove it here in just a little while. But higher volatility does not always equal a better time to trade selling based premium structures. It really depends on the structure you're using. So the components of a volatility or the components of a single option, let's kind of go into what I'm kind of alluding to, which is, does high volatility actually, mean that we've got better options? Well, what ends up happening is in a structure like a butterfly or a condor, you're starting to use a spread. So when we look at a single option up here, when we sell a single option, so let's just say we're selling an option right here, near wherever the money is. Well, that has a specific volatility, and you can kind of run that all the way over here to the corner, right? And that has a specific volatility. Well, then what if I look at a volatility or selling an option out here? The amount of volatility, right? So if I'm selling an option right here, the amount of volatility is substantially higher than the volatility of ATM. Now, it doesn't mean the option is more expensive, but the actual volatility itself is the implied volatility of that option. So, and as you go further out, you can kind of see that. And then, of course, in the S&P, you end up having lower volatility over here. And we will definitely get into that some other day. But the point is that we are not only, so now let's try to break this down into going from a single option, from selling a single option out here, selling a single option out here. And let's just think about how a lot of us trade, right? Especially retail traders. A lot of us don't just sell a naked put, right? That's, most people aren't going to do that. The cash secured puts, I mean, they're expensive. I mean, sure, there probably are some people that do it, but most of us wouldn't. We do a spread, right? And that's where things get very different. So the initial assumption of the volatility being higher is better for selling options is absolutely true when you're dealing with a single option. But when we start dealing with hedging an option, and remember, hedging is buying something to mitigate the risk of what you're selling. So if we sell an option and then we buy an option that's, say, further out of the money from where the market is, we end up creating a vertical, right? And this is very common, right? And there are all sorts of different variations of verticals. We've got all sorts of different names. We've even got, ratio spreads that are the mixtures of positives and negatives and different ratios, all that stuff. So I digress. The point is everything is typically some sort of derivative of a vertical when we start to deal with spreads. And I am talking about a vertical spread, not a horizontal spread, just for those of you guys that are with me. And when we deal with a vertical spread, you sit there and go, okay, let's go and we sell here. And then what if we buy back here? So we're selling less implied volatility and we're buying more implied volatility. Now, typically that you're like, okay, that's fine, but this further option is cheaper, right? And, because this is closer to what's called ATM, and that's in general, because yes, if you lay a probability curve over this, I know I'm starting to get a little bit heavier here, guys, but hang with me. If you draw a probability curve over here, the probability of that option is significantly higher than the one out of the money. And so it creates more of a price. So yes, you're right. The implied volatility isn't the only factor that we're dealing with, but it's something. So let's kind of keep that in mind. So now I'm going to show you something that's going to really be kind of crazy here. And by the way, I'm going to get things a lot simpler at the end. So if you're not too into this, heavy modeling type of thing, don't worry. It'll get a lot simpler here in just a second. So as we go through this graph here, let's just kind of talk about this because we're dealing with spreads, not individuals. And so what I've compiled here is my specific calculation for dealing with what I call the spread differential or the spread volatility differential. And so when you look at spreads and where they are relative to the market, and just in general right here, the market is right smack dab in the center on this line right here, right? And what ends up happening is you can see on this graph, the higher the surface is, so you can see these kind of peaks back here and this kind of peak right here. And you can see that we've got ripples and higher values over here that when we get closer to expiration, so trade days to expiration, right, is going to be across this axis. As we get closer, you can see that we kind of get this warpage, right? And further out, yes, it is warped, but it's not as warped, right? And then when we get right here at, roughly speaking, 7 days or so to expiration, things go really wonky. We're not going to talk about that. That's a whole different, kit and caboodle, and that's not what the Abe indicator is designed around. But from out here, say all the way out to 70 DTE, even 90 DTE, you can kind of see and pull the models together with how the volatility is impacting spreads near the money and out of the money and how it's impacted. So the lower values, so you can see we've got some blue areas in here. Think of these as like little puddles, right? And those little puddles are very low valued spreads. So in this particular time, when I took this snapshot at this, the spread volatility differential was not in favor of verticals that are pointed towards the money. So basically, it's telling us that the options near the money relative to the options out of the money are underpriced, right? And so they're as far as their volatility is concerned. So that's what that graph does. Now, going into another variable, which if there's anything so far that I've gone through that I need to stop on, Tom, is there anything that's been blasting through here, or is everyone just glazed?
No, we're good.
All right, we're doing good. I know that we've got so many advanced traders, especially here at Aramir, and probably if you're watching this recording, you're probably a more advanced trader. So I know I'm probably going to brush over some things that you already know of, and hopefully there's going to be some other things here, but that's probably why hopefully I won't get any questions, or I'm explaining it really well. So contango, let's go through contango. So what is contango, right? So at the money contango, this is what most people kind of think about when they see options decay. And so let me just kind of explain this graph here. So this is the extrinsic value of an option, right? And this is the what I call TDE. It's trade days to expiration. I don't really use DTE that often, but this is trade days to expiration. And so all the way out here, you can see where 20 some odd days away, trade days to expiration. And as this option, this is an at the money option, as this option moves forward in time, right, we can see what it's priced at every expiration going all the way over. And we can see its decay just one day at a time. You can see it's just decaying, decaying, decaying. And this is always something that I think is a really important note here, that us as humans, we always think of decay as a very linear thing. And what I mean by linear is a straight line. So we think every day we just march down, right? And this is just easy, right? March down, march down, march down. For those of you guys that like to get into the math of the Black-Scholes model, it uses square root of time, which is more of a square root function. If you're not into that whole, hardcore math, you probably are still on the linear type of thinking, that we think that assets decay in a linear time frame. Once every day, we'll just get like a chick, 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 and we'll make more money. And that's not actually how it works. How it works is actually more of what's called in contango, is that the option starts out at a certain value and then it slowly kind of drops, but then it kind of accelerates faster and faster and faster all the way down into expiration. So that's at the money. That is typically how we think of options decay. Now I'm going to blow your mind, because even this graph, which is completely accurate, which is at the money, so this is a key point, is at the money contango. This is totally different for options that are away from the market, right? That are further out, away from where the market is trading right now. So out of the money options. And this is where that contango comes into play. So here's an at the money option that is basically what we were talking about, where we kind of go down and then we kind of slowly accelerate faster, 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 all the way into expiration. So that's this at the money option. But then as soon as we jump just a little bit out of the money, right, we can see that things are starting to change. We're starting to get a different signature where it's dropping, and then it almost slows down going into expiration. And that gets amplified further and further and further away from the market. And this is something that's really interesting. Well, remember what I told you, that most retail traders were not buying or selling a single option. Typically, we're using some sort of spread. And especially if we're using a butterfly or a condor to make our quote unquote theta, right? We are using spreads. In fact, we're using two spreads looking at each other most of the time in a condor or a vertical, right? And so how this option decays, right? How our short decays, let me find my pen here, how our short decays on our vertical, our short right here, how that decays relative to our long that we had to buy in dollar terms depends on how much money we actually make on a per day basis. This is monumental when you start to really understand, when we understand that an option itself, yes, is decaying at a certain rate. But if we have to buy something that is also decaying at a certain rate, we need to know the decay difference between those two, right? Just like we need to know the volatility difference between those two that I showed in this previous graph, right? We need to know the volatility difference, which tells us a lot about how they're priced at that moment. We also need to know how they're going to decay from that moment going forward, right? So let's take an example of this kind of system or this kind of concept, and we're going to even go one step further. So here I've got two different dates up here, and this is where it just gets really crazy, right? Not only are there differences in decay, so this is very similar to what I was showing you earlier on the right side here. Not only is there differences in decay from out of the money to at the money in their signature, right? You can see this kind of concave versus a convex, right? Type of signature. But then you have different environments, like in certain crashes or in just different environments, just the market is behaving a certain way. And the contango signature is dramatically different. Dramatically. So just to keep in mind here that I am scaling based on the volatility here out of the money. And no matter how far I go out of the money, it doesn't change the signature. And what I mean by this is, here, let's just kind of move over here to this right side. We're using a 20-point increment from one, basically at the money to out of the money. And then we kind of go a little bit further. We go 30 point, or I think we're going 30 points, and then we go, a little bit further. And so this kind of shows us this kind of scale. So we're kind of, moving just a little bit on a point value out of the money, right? Then in 2018, when the volatility was a lot higher, so now I'm on this side, right? I'm actually 97 points between here and here. And that volatility signature is still the same, that we still have this concave, or this concave kind of dome structure on both options. Then I go 300 points out of the money and it still has this signature. And then I go 400 points out of the money and it still has this signature. So the assumption that an out of the money option will always have this type of signature on the right side is completely wrong. So we need to know, how is the market behaving right now? How are the options, decaying relative to each other? How is the volatility priced relative to each other? These are all variables that we can take in mind And then, of course, if you're really advanced, you can take these types of variables, shove it into a machine learning algorithm, and then boom, you can really start to have some good times, along with a options pricing model on how much they should be priced. And that's where the Abe comes along, because that's what it does. But we'll get into that more later. So first, I'm going to kind of show you how this actually impacts an actual trade, right? Because this is where the rubber meets the road here. And so we're out of theory land and we're into, okay, I'm going to buy and sell these two options. So we're going to sell a deep out of the money option and we're going to buy a very deep out of the money option. And we're going to see how this option decays over time if the market were to not move whatsoever. Boom, we're just making our pure theta. And that's what this line shows us. So this is the extrinsic value over here, right? This is the time as we go through all the way to expiration. And you can see that we start our little trade out right here. Ignore the red line in the background, by the way. Our little trade back here starts out, and you can see it decays very nicely, almost linear, in fact. And that's what we would expect when we have a trade that's positive theta, is that it decays at some sort of level like that. Great. That is a out of the money option in this particular environment. Now, let's say this is the same environment, but we're going to go to the at the money option and we're going to go to a slightly out of the money option. So this is a vertical as well, right? But it's now we're priced near the money. Let's see how this plays out. Very, very different. In fact, the strangest thing starts to happen is that you actually lose money going into expiration and then kind of flatline and start to finally decay as we get into, roughly 10 days or so. Now, it's kind of an interesting concept that all of a sudden the advent of zero DTE options and really close to expiration option strategies have been pushed so much lately. And it's because there are times that people aren't measuring this out here. There's not an indicator out here for retail traders or anything. And in fact, on the institutional side of things, I promise you there's not very many that deal with this as well, right? The deal is that there are times that you do not want to trade a vertical near the money if you're trying to expect some sort of theta decay. And the traditional models, the traditional decay models that we see in O&E or Thinkorswim or, lots of different, options decay models do not take this actually into consideration very well at all. I promise you, it just doesn't exist. So, and I mean, I know you guys have been in this boat because I've asked this question a million times on other presentations that I've had. How many times have you put on a structure and the thing has not decayed or has actually gotten worse and the whole T+0 line has sunk out on you in the middle of the freaking trade? And you're like, oh, it must have been volatility. Oh, it must have been the market makers that day. Oh, it must have been this or that. And we always try to make up these different reasons. But you can predict that. You can actually, like, before putting on a trade, know if that trade's going to behave like that. And that is the piece de la resistance of actually what is happening here. So asking for a structure like this to decay is like asking to see a unicorn in the middle of traffic. It's just not going to happen. That's not how the market is priced in that time period. And it's not how those options are decaying. So you're at a significant disadvantage by putting on some sort of butterfly or broken wing butterfly or some sort of condor structure that is near, trying to get that near the money type of decay, or those verticals that are looking at the money that are, relatively close to at the money. So that's where the Abe indicator comes for, and comes in. And then, like I said, this is the at the money butterfly edge, and it attributes to condors as well. So we compile volatility, the volatility surface, right? This is the spread volatility differential. We combine this with my proprietary options modeling to determine if those options are relatively priced well or priced not so well in that particular options environment. Then We also look at the decay signatures of those options. We feed that into a machine learning algorithm, and boom, we get our Abe indicator. Voila. Now, how to read this thing and what is it, right? Like this is how I use it. Now, I've got actually other members that use this differently already, which is kind of really cool to hear this. But its original intended purpose is that it was to tell me if I could put structures like butterflies and condors near the money at a given day, right? And like I said, I use this a lot during or in my Adapt Advanced, and it's also tied into my Adapt Dailies strategy. But this is I wanted to release this so that people could have it for their own trades that maybe aren't trading some of my systems and are trading other things that use these. So over here on the left, we've got a meter, and this is how it looks at airmere.com. We've got a meter and there's the number down here, right? And this is just basically telling us, okay, today, what is the inherent, edge in placing a structure at the money? Does it have a strong advantage? By the way, this was taken yesterday. So a very low reading right now. And we want to know the second step. So we want to know where the absolute reading is. So this is the absolute reading. So we need to know if this is high or low. So is it high or low? So we want to see this graph. In a perfect world, we'd like to see this way sky high, right? For a good time to put on a butterfly. But then we also need a second step. And we need to know over the recent period, are we rising or are we falling? And so that's the second variable that we need to know on the Abe, because just this value alone isn't all that we need. We actually need to know, are we rising or falling? So if we have a high Abe indicator, so something like right here at this time, if we have a high and it's rising, right? So it's coming from its lows, boom, it is awesome time period to start putting on some of these structures. You're going to get quick decay. We're going to get awesome risk on or a return on our risk. Most of the time, I've put on structures out at 70, 60, 50 DTE, and you can get the decay that you typically see at 10 and 14 days all the way out there. It's awesome, right? But then vice versa, let's throw this on its head. If we are low and falling, like where we are at yesterday, it is a nightmare to put this thing on. And I'm sure some people that might have traded yesterday and put some at the money butterflies and stuff like that, thinking because volatility was high, it was a good time. When the market rallied midday yesterday and even today when it rallied higher, it probably got all sucked right out of that trade and it didn't actually make money, right? The market moved away from the structure and it just sucked all the value out and it probably didn't prop up. Now, how a lot of trades have fixed this or have been trying to accommodate for this is they put some sort of other structure to hedge the fact that the butterfly sucks at this moment. So they put on a call or they put on, out of the money verticals or debit spreads or something like that to deal with the fact that the butterfly is going to get its face kicked in when the market moves or if it sits still or something like that. And, so we're trying to, we convolute the fact that the structure itself has lower edge by putting on these extra structures to try to help it out. So anyways, and it's not a bad way to go about it, but it's nice to know if the base structure actually has edge in the first place. So that's how we read the at the money butterfly edge indicator, the Abe indicator. And like I said, it works for condors too. Now, if you start taking on verticals like I had talked about that are way deep out of the money, so say something like past a standard deviation or maybe even a half a standard deviation out of the market, out of the money, and you start putting on verticals way out there, you're probably not going to apply to this as well. And in fact, you might actually start to get some sort of opposite readings sometimes. So I would always emphasized to take some of this data, some of the historical data that we've got up here, and I think Tom's got that on the informational page, or he's getting it up there pretty quickly. That does it apply to your specific trading style, things like that? How to kind of use this, go through backtester, have a good time, right? And so you can see here, just in general, over time, that you do get a bunch of these spikes that kind of come up and down, and you get some opportunities. But and I make it as easy as I can with, or Tom and I have made it as easy as we can to make it, green, red, gray, whether we've got edge in it or not. So these low times when we're falling, definitely a bad time. But high and rising up here, doing really good solid time to put on some butterflies. As soon as you start falling down and you have an at the money butterfly, you might want to get rid of it. Those types of things, all sorts of different variations of how you can kind of use that, right? Okay, so I'm going to peel off here, and we're just going to go to a couple dates here, and I'll just be able to show some of these things. Before I do, and I go into an example, there might be some questions or something. Tom, has anything came in?
Yeah, there was one. Mike asked, how does DTE come into play? In other words, could a 4 DTE structure not be good to trade, but a 30 DTE might be great to trade?
Yeah, so that is fantastic. So there was a graph that I showed earlier in the presentation, and I can probably hear it. Let me just zoom back to it really quick. Right here. So you can see here that something dramatically changes as we get into, and ironically enough, it definitely changes at like 4. This is TDE though, so remember I use trade days to expiration, not days to expiration. So ignore holidays and weekends. So this is roughly a week to expiration or so. You can see that this volatility signature, right? This spread differential is dramatically different when we come into here. So absolutely what you're saying, Mike, I think it was, that once you get too close to expiration, you kind of have to throw some things out the window, because the mathematics of the option having to go to 0 start to become so strong that just the raw price that you actually get, hey, I sold this for $100, I bought this for $10, that takes just way more precedence. So then your actual intrinsic risk of the option itself is really what starts to matter most. So you're really more interested in actual market movement and things like that. And that's why, you've got to be so on Johnny on the spot on those. So when you start to get further away from DTE, you start to have flatter T+0 lines, and the market kind of moves around, and volatility has a larger impact, and decay structure and decay rates start to show up a lot more. And so that's why I said that this indicator is really designed for, roughly 10 days out or more is really where this kind of lays in. And if you're trying to push a trade, or you regularly push a trade closer than 7 days or so into expiration, it's probably not going to be as informative for you. I say that with a big asterisk next to it, because I've got a couple members that have emailed me about their results and how they've started to use it at their trades that are 0 DTE, and I'm just, I didn't originally intend it to be that way. So I'm only going to speak to how it was originally intended. And if you want to play with it and do other things and see if it matters to your trade, go right ahead. But originally it's intended to be 10 days out or further, and it goes all the way out. I mean, you'll see that it has impact all the way out to 90 days. It really does. So anything else there, Tom?
Oh wait, Rich had one. Do you always calculate the TDE instead of calendar DTE?
Yes, I always use TDE. That's something that I started doing even before I worked at the hedge fund. When you start modeling decay of options, you'll see that trade days to expiration is much more meaningful to the market than just raw days to expiration. You'll see that it creates a smoother signature and a more predictable decay pattern for the options. All right.
That's it.
Well, if there's some more that comes through, we can definitely hit those up. If not, I'm just going to jump over to a date here. Let me get back to this. So I wanted to show like here, like a low and falling edge, right? So like 4/11 of 2019. So I'm going to just grab two of these and we're just going to see through, and maybe I'll go through one more. So 4/11 2019 is a low and falling edge. So I'm going to move you guys over to my O&E as soon as I get that date up. So bear with me, guys. I know this is like all righty here. Okay. So new share, let's get this over here. Oh. And Tom, can you let me know, make sure that you can see my O&E?
I can.
Perfect. Okay. So this is just a normal example of what most people are kind of familiar with. So this is just why I use this structure. But what I did here is I put on a butterfly, and then I wanted to just zero out the delta to try to remove as much directionality as possible. And so what I did is I just broke that front wing. So a lot of people are very familiar with broken wing butterflies. So this is 4/11 of 2019. This is a low and falling edge on the ABE indicator. So let's just see over the next couple days, right? How does this perform, and can it handle what the market is like? And do we really see strong decay, right? And of course, I cherry pick these things, but of course we can go to any example and they're all going to basically start acting very similar. So you can see here the market goes up. And strangely enough, right, market goes up, volatility is relatively normalized, and nothing, right? We haven't seen decay. And in fact, when we went all the way up here, we actually started to lose a little bit of money from a slight amount of market movement, right? So let's go another day here. And all right, so we're getting some excitement here. We've got a little bit of decay coming in the trade, right? And so we move forward, right? This is, so we're going day by day by day. And so this is when most people are like, look, the volatility is coming into the trade, right? Because we're starting to see the T+0 line lift and all that stuff. And it's kind of getting exciting. And what you'll see here is that this is really nothing strong, right? What's happening is yeah, that's releasing a T+0 line behind us, but that's not where the market is, right? So, and keep in mind that we're now 24 DTE, so this thing should be decaying rapidly fast, especially in at the money, right? And we'll go forward another day. And I wanted to just show this example because I wanted to show that it's not like you're going to, be absolutely crushed. And I will show you one more example that it does when it's a really bad ABE. This is a relatively low ABE and it's falling. So it's not a great time. It's not really decaying well. It's just kind of there. And then finally, we start to get decay. But what's interesting is the day before this, the ABE indicator started getting really positive. So we started getting really rise. And so wouldn't you have rather get in on this day, right? Then, on this day when you were just barely up and start out, boom, instantly get 4% from one day to the next. And you start to get your good decay that shows up, right? So let's go through another example of a high and rising. So that way you guys know like really what the decay kind of shows up when you've got good strong edge. So 8/16 of 2019, right? So 8/16 of 2019. So this is the same year, right? I'm just at a different time, right? And excuse whatever randomness I have on here. All right, so here's my option structure. I'm just going to kind of zoom out. And it is the same exact basic setup. It's a broken wing butterfly at the money. Yes, I've sized it differently because the market has changed, but I normalized everything as much as possible. So this is the market, by the way. The market is a little bit higher volatility, right? We've definitely got some in here. And like I said, sometimes volatility is an edge that we can use. But watch this thing. I mean, this thing, it will just blow your mind at how fast the money just dumps into this thing. Every day it just click, 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 click. It's just ratcheting up and up and up and up. Now, of course, I didn't try to delta normalize any of these or anything like that. So I just kind of let them be. So if the market ends up shooting out one side or another, it'll do its thing. But the point is that you'll see that even in these crazy market environments, 2 standard deviations to the downside, the market drops like a brick. This thing can handle it, and the theta or the decay is still in this trade, right? And then inevitably, of course, we end up getting some really massive gains as I just keep clicking through these day by day by day because it was a good environment for it. And then I will show you basically the worst case scenario, 6/9 of 2023. This is basically just a death sentence. 6/9 of 2023. And ignore probably whatever crazy trade I've got on here. Yep. All right. So, okay. Oh, I got this 6/9. Oop. Let me see. I've got this probably. Hold on. Let me get to the end of the day. I think. All right. Let me see if I've got. Oop, not that one. Yep. Here we go. Okay. It changes throughout the day, by the way. Okay, so here we go. We got the same setup. Perfect. So here's our broken wing butterfly. Market's where it's at. Actually, the volatility isn't necessarily low in this point. I mean, it is lower, but it's nothing bad. We've seen low volatility with good ABE, and you get massive decay. So, like I said, we kind of got to throw out volatility in general, even though these examples I had a high volatility in there. So go into here, and now you can see that we've got a pretty wide structure on here as far as our butterfly goes. I normalized this so you can see it's pretty wide, and it can handle quite a bit of range, all that jazz. So let's just see how this thing handles it. By the way, the ABE reading on this was, I think, 0, and it was falling. So it's literally like the worst reading you can possibly have on the ABE indicator. For the love of God, do not put a trade on this day. So let's just see how it works out. All right. So we had market movement to the upside, and we basically got annihilated, right? We're down 6% in a single day. You saw it in some of the other trades that I even showed. Even when the ABE indicator was low, but it wasn't like, death sentence low, we still got at least some hold up when the market went up. This time, now the market went up and we get crushed, right? Okay, fine. Well, let's just see how it plays out. Maybe volatility needs to eke out a little bit further, right? And here we go again. We're just getting crushed some more, right? And so not only is the market moving rapidly, which is part, what kind of pulls up into the ABE indicator as well, right? Because there's an algorithm back here, right? The machine learning algorithm that's dealing with the probabilities of these options as well, right? This is just destruction. I mean, the trade never decays. You never have anything. The whole T+0 line is just garbage. It sinks all the way back. It was the worst day to ever enter into a trade like this. And I'm sure that you've had some trades that you've gotten in that are normally decay-based trades or some sort of broken wing butterfly-based trades, and the market has moved and the whole thing just got crushed out. It's nice to know that there's a high potentiality that could happen before you put that trade on, right? So you can do a few things about it. And so let me just come back to the presentation here. And So I can go through just a few time frames of when I remember it most, right? When I was trading structures, and if I wouldn't have been paying attention to this, it I would have just gotten nuked, right? And maybe they'll ring bells for you if you were trading during these time frames. So, like the beginning and like the first few months of 2018, the Abe indicator stayed low for a very long time. In fact, even though there was high volatility because we had Volmageddon in 2018, it sucked to try to trade butterflies and condor based stuff. In fact, there's a lot of retail trading systems that blew up during that time period, right? Nice to know, right? Then another one that really sticks out in my head was actually the crash of 2019, the December like meltdown that we had going into Christmas of 2019. If you had some sort of butterfly structure on and the market just kind of kept going down, it just basically just kept just sucking out value as the market kept going down. It was kind of crazy, right? Another one that got pointed up to me last time, or one of the times that I made this presentation, was actually COVID. Let me see if I can find COVID on here. Yeah, COVID's right here. So, COVID, this is actually like the crash of COVID right here, this whole little section. And the Abe indicator stays pretty low, right? It's definitely not telling you that there's a strong edge, even though volatility was sky high. It's like, no, 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 don't do that. And there was a lot of butterfly traders that got blown out in their, quote unquote, negative Vega trades because the market just sucked it right out of their trade. And then, of course, it wasn't very far after the bottom. Actually, it was, I think, on like, I'm not going to quote the day. I'd have to go look at it. But the Abe indicator gets up to about like 60 something, which means it had a really strong edge. And if you start putting on butterfly based trades, then it still had a lot of elevated volatility in the market. You just print money. It's really nice way to go about that. Of course, there was earlier this year, which I showed you guys, which was that last example that I showed you when the reading was basically at the lowest point you can almost get. You can see there, we actually bottom out at zero, and I showed you guys that. But it's very rare that we get down that low, but there are a few times a year that you get down very low, and you really wouldn't want to put on a structure like that. So it's nice to save those losses. Um, so what to do in a bad environment, right? Basically you could Warren Buffett style it and just not trade. That's really, patience, things like that. You could reduce the allocation to the, your butterfly or condor based trade that kind of deals with that. It's kind of a Ray Dalio style. So you change your allocations. And then of course I kind of have my style where I use different edges, different structures. So I do that in my version, right? The adapt dailies and then the adapt advanced. I do that. So you can kind of go about it a different way. So we're offering this here at aramir.com, and you can go to the links here at aramir.com/Abe for a super good value. Like I said, I can't trade without this. I mean, I would have lost many, many hundreds of thousands of dollars if I didn't use this tool. So $27.95 a month, or you can get it for a whole year for $300 a year. But right now, because I'm making this presentation for the first time here at Aramir, for a limited time, if you do sign up for a year, you can get 2 months free right now. So that makes it $250. And the links are right there below. And Tom, was there any questions along the way?
Yeah, Rich asked, can you show the chart for 8/15/2019?
Let's see, 8/15/2019. Let me see here. I'll just pull this up and then I'll go look at the data right here off screen. Let's see, 8/19/2019, right?
August 15th, 2019.
August 15th, 2019. That probably should be somewhere. Yeah, let me just go look it up. I have it over here. So 8/15/2019. I'm guessing someone had a trade they remembered specifically.
Oh, and then Rich said 8/16. So the next day was the first example.
Yeah, let's see. So this is 2019, right? 2019. Yeah, my bad. Yes. So, 8. Oh no, that's
August
2020. Jeez.
15th.
Yeah, I know. I'm looking at my my graph right here, and I just have it in the wrong spot. Here it is. Uh, okay. So we've got about middle Abe. So we're 49.95. It's not fantastic. I'd say you're kind of eh, it's okay. But it is rising. So one thing about a rising is that you've got kind of an, like I said, an A/B test on when you want to put one on. You want to make sure it is rising, so that is kind of a good thing. And then you want to have a high value. And right now you're kind of in the middle of the road at 50%. It's really it's okay, but I like to stay away from the gray areas just because it's almost kind of like a crapshoot on how well you're gonna do. Whereas, yeah, just a few days later, if we wait for it to just get to like 822, we have an 84% ABE that's rising, and you basically just like print money. So it's not terrible. A few days prior to that, 812, 8-6, all of that is just absolute garbage. It's a terrible, terrible time. So you're really coming from a bad time. So if you had a trade going on during that time and China transitioning, you might have had some challenges. But Tom, did you end up getting that data up on the site yet?
Um,
The historical?
the one that's already on there, or oh,
Just like the
the
historical values of it for per date.
well, I mean, it's on the chart for the last 90 days, I think.
Yeah, yeah. So you can see the last 90, and we'll get some more historicals. So like I said, because I'm looking at this a few years back, we'll get some more historicals and we'll be able to post that up so that way you guys can kind of just see different values during different times.
Sounds good.
And then
Uh,
uh, go ahead. Any other questions?
oh, there was one in the Q&A. Do you prefer further out of DTE trades? What's the advantage over example zero DTE?
Yeah. So okay. Yeah. So I have zero DTE trades and structures, and I think they're good. They have their place. I think it's great to diversify not only your strategies but your time frame, because they can definitely have inverse correlation. I've definitely seen that with my adapt dailies versus my intraday. My adapt dailies are just freaking doing amazing right now, and the intradays are having a little bit more struggle. So when you start to diversify across, I think it's good to have both. So with that out of the way, though, my preference is a little bit further out. I really like, in most environments, 20 to 30 DTE is really kind of my bread and butter zone. Sometimes I'll get pushed out. My adapt advance goes into this, but I'll get pushed out there at like 50 and 60 and 70 DTE. I don't mind, just because getting that far out, sometimes you can get a boatload of range. But if the environment is right, you can get a ton of decay that is far beyond what the models are predicting you to decay, right? You can make 4 or 5% in a single day of decay out there at 70 days. And it doesn't even make sense, right? When I tell you those numbers, but it's just how the environments work. So yeah, my preference is a little bit further out.
And then David asks, can A be used effectively on shorter DTEs like 7 to 14 days?
Yeah, I definitely say look at it. Look at it with whatever trade. You probably have something in your mind that you're using. Look at it, or sign up for a month or something like that. It's $30. It's a lunch. Well, I live in Seattle, so it's lunch here. But
That's dinner here. Yeah.
yeah, there you go, right? Yeah, dinner is twice that, but Yeah, so it's less than dinner here on the West Coast. But the point is sign up, watch it for a little while, see if it means something to your trades. If it does, then stick with it, use it, find a way to use it. That's what the tool is for, is really to help others with their trades that aren't trading like my style. They're trading something else, right? Just because some people aren't aware that it does have an impact on this. So yes, it can correlate. Like I said, I've had a few members that have found ways to do it. I won't speak to that just because it's not my data and it's not it's their trades. So if they want to come out and say something in the forums, if they're part of this community or something like that, or they see this recording, I'll let them do that. But they've definitely found a way to use it in those time frames, but it wasn't designed for that.
Oh, there's one more. What's the relationship of Abe to the VVIX?
Yeah, so the VVIX, just to kind of clarify what the VVIX, for those of you guys that might not know, that is the volatility of the volatility. So that's the basically it's the VIX of the VIX. And it, not to my knowledge, it has no correlation. But I mean, it could. I mean, I don't. It's not part of the model's parameters at all. But it could, just because as the volatility swings around pretty rapidly, the implied volatility of the actual volatility itself gets ramped up. And that can really start to impact options pricing basically across the entire spectrum of strikes. And so it might actually have an impact indirectly to this, but it's not designed that way to read that at all.
All right, I think we got through all the questions. Oh, wait, one more. With your service, can we use it for other underlyings?
Okay, now that is something that I definitely should have added in here, and I almost apologize for that. So, this is designed for the SPX. Now, because the SPX has a huge correlation to the NDX, to the Russell, to other assets, I've definitely seen that it's helpful for other underlyings. But just know that its direct data is coming in from the SPX and from those specific options modeling that I have. So, and the entire calculations are based on that.
Okay, I think that's it.
Boom. All right,
No
man.
more, no more
Great
questions.
questions. Like I said, dude, quality traders here at Aramir. So, I just the questions that come through from you guys, I can always tell that you're talking to an advanced group or someone that knows trading quite a bit and everything like that. So it's really pleasant to always present here.
And I put the link at just airmere.com/Abe. That'll take you to the information page, and then there's a button on there to order it. If you want to do the monthly and try it out, or do the annual. The annual normally is going to be 300, but it's $50 off for I don't know how long, Wayne, what, a week or two?
Yes, 2 weeks.
2 weeks. Okay, perfect. All right. So if you want to try it out, it's been on the website for a while, but now it's time to make a commitment. So hope you guys sign up and use it to help your trades. And thanks very much, Wayne, for bringing this to us. It's a very interesting tool and looks very useful.
Absolutely. Always a pleasure. I'll talk to you guys next time.
All right. We'll see you. Bye.